So, hello everyone. Today we'll be talking about looking at the price. So, it is something that almost everyone does, but a lot of people will not admit to you that they do it. My opinion is that you should not shy away from using it as a tool and a very important one at that. So, a lot of people disregard price action blatantly. They just say that we only invest based on fundamentals, we don't care what the price does, and you should not associate or you should not look at the price at all. uh, they'll quote Buffett and Munger all day, and they'll ignore the fact that Buffett never made a very large loss in his career, and that was part of why he is so successful. So you cannot be right every time. So even Buffett was not right every time. He was wrong almost as much as he was right, and the only difference was that he also regarded price action in a way that he never had a very big loss. It is only a matter of how much do you know about the company. So a retail investor can think, an individual investor can think that they know everything about the fundamentals, but it's simply not true when you compare their resources with an organized investor. So let's say this is person A, this is person B. Person A is an individual investor and person B is a mutual fund. Person B has a floor of people analyzing just five stocks, let's say. Like this is a floor full of people analyzing just these five stocks. There's like five people for a stock, and they'll basically know everything there is to know about it, and that can be known about a stock. So this information disparity does not guarantee that person B will make more returns than person A, but they will definitely be more informed. And the only way person A can be at par with person B is if they follow price action. That is to say that person B cannot buy or sell, right, without it being in the price. So let's say person B is a very large investor. If he buys, the price will show that he has bought. So why would you want to ignore what a person who's very well informed, perhaps more than you, is doing? So, what the majority of big investors, informed investors, think about a particular company, that is essentially what happens to the price long term. So, I agree that very short periods of price movement, let's say a day or two, or very small movements like 1 2% moves, they do not signal a huge thing unless there is also a very big volume. But if let's say you're holding on to a stock and it is going nowhere, right? You have to ask yourself that if everything is so good about the company, if everything is getting better, why is it not moving up, right? Why is it just not going anywhere, or even falling? So the answer could be that there's just market negativity overall, and that's why it's falling, which is fine, which will happen from time to time. And the reverse can also be true. Let's say you're very bearish on a stock and it just keeps on going up. It may warrant a second look. Maybe you're just wrong about the outlook. Maybe there's something you do not know. Because why would it consistently keep on going up long term if everything is so bad about it? So I'm not saying it's a decisive yes or no thing that this is the only factor you consider, that if the price moves up then it's a good company, if it moves down it's a bad company. That's not what I'm saying at all. All I'm saying is that sometimes second guessing your decisions is very useful. It can lead to better outcomes, and price action is a very very good way of doing it, because it shows the aggregate view of all the people with the most money. So the other thing about price movement is it also helps to screen stocks. I have seen a lot of people ask me that how do I even find stocks that are worthy of looking at, because there's over 4,000 listed companies, and it is not so easy to know which ones to even look at to have on your watch list. So a very simple screen would just be stocks that are hitting new highs. So if a stock is moving up, if the chart looks like this, you might want to look at it more than this, or a stock that's going nowhere. So let's say a stock is going nowhere for 2 years, and suddenly there's a 20-30% move, and the move just continues, right? So this is the point where you would be very, very interested in, at least having a look at the stock, because everyone who's bidding the price up cannot be so foolish as to just be wrong. And there is a reason that this happens. It might be that you're not able to find the reason, and also this saves you a lot of time and unwanted effort, since you did not have to look at the stock for 2 years every day. So if a stock is going nowhere, you don't need to look at it very closely every day and just do nothing about it. So one more thing is that you must also put price movement of individual stock with in context to the broader markets. And if let's say there's a structural bear market, like there are lower highs and lower lows consistently for months, so of course your stock will also most likely fall with the market. But if the rest of the market is okay and this is your stock, this should really be a big concern. You should try to find out whatever is happening with the company, what if there's something wrong with the company. So you may not find what's wrong with the company, but if it keeps on going down, you must always be looking at it with a lot of attention. So the thing is that a stock cannot go down without going down, and you can always just see when it's going down. Same thing when it's going up. It will, have a up move. Every big 10x move, it does not happen as a binary event. There's firstly a 10% move, there's a 20% move, there's a 100% move, then there is a 1,000% move in aggregate of those all those small movements. So if you're looking at the price constantly every day, essentially, it is very hard to miss this move. And you cannot really miss a stock. And same goes with a downtrend. uh, Unless the company is essentially a fraud, it turns out to be a fraud. uh, Things don't fall like 100% in a day. It will first fall 20%, then 30, then 40, 50%. So tracking the price movement essentially ensures that you can be with the big investors, the presumably smarter and more informed investors, without having to do all the work that they're doing. So you can know that something is right with the company or something might be wrong with the company without having to track every information about the company every day. And you can just check the price movement to see and use as an indicator that is everything all right. Are things becoming better than they used to be? Have they become worse than they used to be? And price movements can be incorrect indicators. A company that has consistently been going down, things might be improving fundamentally with the company, but this is very, very rare in on a longer term time frame, let's say months, weeks and months. This does not happen very often unless it's a very big bear market. If the fundamentals are improving consistently, the stock price cannot and should not be going down like this. And these are so rare that it's okay to miss these, right? You don't have to catch every trend, you don't have to make money out of every stock. So I think this outlier is still not a case to make against looking at price movement. So that is it for today, and thanks for watching.